I think when we look at macro, on the margin, things are better. We have better visibility on tariffs into 2026. We have regulation and tax, like legislation visibility into 2026. I think the Fed is now being questioned about their unwillingness to cut. I mean, it was apparent like 5 out of the 10 questions during the press conference were about that exact question. So there's a dovish Fed. I know consumers are overly cautious right now, but as you know, inflation expectations are far above CPI. That's a positive surprise if delivered inflation's lower. And then businesses have been really resilient. You know, I mean, I think actually the economy might be weakening, but earnings have been better. So overall, with all the cash on the sidelines, I mean, I would say we should be quite bullish, actually.
Tom Lee sees the macro environment improving with greater clarity on tariffs, regulation, and taxes through 2026. He notes that the Federal Reserve is facing pressure to ease policy, inflation expectations are outpacing actual CPI, and corporate earnings remain resilient despite economic softness. He highlights that nearly $7 trillion sits in money market funds, showing institutional caution but also offering massive potential for market upside. Bitcoin and equities are already showing strength, signaling a shift toward risk assets and hard stores of value. Lee believes the current market setup is still early in the cycle, not overextended. With solid earnings, a dovish Fed tilt, and a large pool of sidelined cash, he sees strong potential for a broad-based rally ahead.
What do you make of this morning's action?
Well, you know, in some ways it's not a surprise because, as you know, like Art Cashin had the adage, sell the buildup, buy the invasion. And I think today is an example of that markets were kind of already nervous and anxious, and we've already saw de-risking, and the VIX was already elevated. So I think in some ways this is probably pretty typical.
Does it change your call for the rest of the year at all? And you think it displaces any other priorities or has any effect on bill passage or how that might get constructed?
Yeah, in some ways, it actually strengthens the case for stocks to do better into year-end because at the start of this year, we would have said U.S. bombing a nuclear facility is a black swan. Oil would be 120. Stocks should be down 10%. And then we have the event, and oil is not really surging, and stocks are up. So I'd almost say that you've put another stress test into the market. We've seen it pass it, and I think it means stocks should do pretty well into year-end.
Do you think Hormuz remains a risk?
I do, but you know, Brian Sullivan was off camera was mentioning a lot of strategic reasons why that may not be the case. I'm sure he's going to have his views, but I would say I'm watching oil, and if oil isn't surging, then I think it just means that the risk of the straits being closed is lower. Yeah, and as you know, core CPI doesn't include energy, and as you know, when the ECB looks at core inflation, they exclude housing. Housing is not part of ECB's core CPI, and they're cutting. If you calculated U.S. CPI on the same exact basis, it's lower than Europe. So I do think there should be a dovish tilt towards the Fed, or that's the upside opportunity into year-end as well.
Tom, there seems to be a speculative nature to the market that's creeping in again. You've got a lot of SPACs coming back. I don't know if you've seen it. Yeah. Even Chamath is coming back with some SPACs. Any concern to you or no?
It is. I mean, those are echoes of 2021, which is some stocks get fantastically bizarre valuations, and I'm not naming any. And
you want to name some?
And then there is signs of speculation. And but the one thing that was true in 2021 that's not true now is when I meet with fund managers, in 2021 they said there was no stock they could buy because everything was expensive. That's actually not true anymore. Now the people I talk to are saying, look, the numbers have been better and numbers are going up, but the macro is making them uncertain. So there's actually a lot less risk taking by institutional investors. Yeah, I mean, to me, David, it's the sign that the cohort that is speculating are the ones that bought the dip in April. As you know, it was retail, the Robinhood community, that was buying in April when institutions were selling and raising cash and high net worth was raising cash. So it's the same crew now that is buying, you know, the circles at one time's assets under management, which is tremendous. But it's not speculation to me yet because I'd say high net worth is not really that invested and institutions are still pretty cautious.
But what is the underlying view that you have that makes you bullish? Is it that the economy is hanging in? Is it that earnings are picking up? What's the fundamental reason?
I think when we look at macro, on the margin, things are better. We have better visibility on tariffs into 2026. We have regulation and tax legislation visibility into 2026. I think the Fed is now being questioned about their unwillingness to cut. I mean, it was apparent 5 out of the 10 questions during the press conference were about that exact question. So there's a dovish Fed. I know consumers are overly cautious right now, but as you know, inflation expectations are far above CPI. That's a positive surprise if delivered inflation's lower. And then businesses have been really resilient. I think actually the economy might be weakening, but earnings have been better. So overall, with all the cash on the sidelines, I would say we should be quite bullish, actually.
Tom Lee sees improving macro conditions with clearer policy outlooks and a potential shift by the Fed toward rate cut. Inflation is cooling, earnings are strong, and despite cautious sentiment, the market shows signs of resilience. With trillions still on the sidelines, Lee believes there's major upside as capital begins rotating into risk assets like stocks and crypto. He views the current setup not as speculation, but as the start of a broader bullish trend.
The reason I wrote the book is that for about 50 years I've been in the markets betting on these things, and I wanted to convey the mechanics of how the process works. So think about it this way. The credit system is like the circulatory system, and that it brings buying power throughout the economy, and by creating credit, you create buying power, and that creates debt. But if that debt produces income, then that's a healthy system. If it doesn't, it produces interest rates and debt service that build up and crowd out spending. And so we can see that happening to the government. So now interest rates, for example, are now $1 trillion. So let me put the budget in perspective. That number that you gave is a wrong number because it is the amount of deficit on top of the amount of deficit that would be there. $7 trillion is the amount the government spends every year. It takes in $5 trillion. As a result, it's got a $2 trillion deficit. And it works the same for governments as it works for individuals or companies, except the government can print money. And so that is building up. Over the next 10 years, it's going to increase by the debt, and the debt service is going to increase by more than 10 times that $2.5 trillion number, because that number was a number on top of the deficit. So what we're having is a crowding out, like in plaque building up in the system, a crowding out of spending. And that amount of debt now is about $230,000 per person. So you can see it happen in that way. In addition, you have supply-demand issues. In other words, one man's debts are another man's assets. And when there's a lot of more debt that's being sold, then you have a demand problem, not an adequate amount of demand. We're seeing this happen now as central banks and foreign investors are buying less and, in fact, shifting to gold. So there's that dynamic that I'm trying to convey the mechanics of. It's not political, and there's something we can do about that, what I call the 3% solution. And you could see it. Okay, if you understand the mechanics, you can actually see it. So you could see that this debt service has now crowding out spending. So you can see you can't cut spending very much. It's fixed. And that the interest continues to build up that way. And you like plaque. So if I was a doctor looking at your circumstances, and I could show you that building up and I could show you that crowding out, you can also see the supply relative to the demand. And you could see the big imbalance. And then there's the big risk that not only is the supply of new supply a problem, but also those who are holding the bonds may not think they're going to get a good real return. If you study history and you see this, you would not want to hold those bonds expecting a good real return, and you could see selling. And so that dynamic is, you can see it mechanically. And you could also see that we are at the point in that cycle that the adding that debt from just this next year and the next 2 years will put us over the edge, could put us over the edge, very close to that, because you're now having the need to create debt in order to pay the debt. And so when you see these debt cycles, there are something like 50 of them looked at in this book. When you get that the debt is having to pay the debt, then what happens? You have the government come in and the central bank, and you have printing money. You're entirely right. From 1991 until 1998, they reduced the federal debt by 5% of GDP. We could cut the federal debt right now if it's done in a certain way, 3 ways. You can cut that down to 3% of GDP. You need a 3% of GDP. It's now going to be about 7% of GDP. If you can cut that down to 3% of GDP, then you change the supply demand, and you don't have that compounding effect. And there are 3 ways to do that, and they have to be balanced. The 3 ways are, of course, in spending and in and tax revenue. I'll emphasize revenue, and also then interest rates, because interest is such a big component of the debt. If there's lower interest rates, but you can't force those interest rates down, because bondholders won't want to hold it if they get a poor interest rate. But you have a situation where if you change the supply and demand, you will naturally have a lower interest rate. So we're at that point now.
I wonder, Ray, if it is indeed possible, in your view, to get to your 3%. Without cutting Medicare, Medicaid, Social Security.
The way I do the numbers, I find if you could take it about a 4% cut in spending and a 4% improvement in tax revenue, that you would get enough of a decrease in the deficit that you would also naturally have about 100 basis points, maybe more, decrease in interest rates, and you get very close to that you have to, so you have to bring it in that order of magnitude. I'm not saying that that's easy, but it's a political question. When I go to Washington and I speak to people on both sides, everybody agrees with what I'm saying. I mean, meaning that you have to get it to 3% of GDP and so on. But it's political because it's like being on a boat headed to rocks. And on the boat, everybody agrees you have to turn. And they can't agree whether you turn left or you turn right, and they're going to go right into the rocks. And so it's a political question. I think the period from 1991 to 1998 that also Joe is referring to is a good model period to take a look at how to best do it and realize that the consequences of not doing it are disastrous.
Tom Lee sees a bullish setup with improving policy clarity, strong earnings, and trillions in sidelined cash ready to move into market. He believes inflation is cooling, the Fed is turning dovish, and risk assets like Bitcoin and equities are set to benefit. Ray Dalio, however, warns of deeper structural risks, rising debt, slowing growth, and weakening trust in fiat systems. He urges investors to prepare for long-term volatility and global realignment. Are you more aligned with Tom Lee's optimism or Ray Dalio's caution? How are you adjusting your investments in this environment? Share your thoughts in the comments.